All right, today we're going to tackle something huge, the very language of business itself, the core concepts of accounting. Now, these aren't just stuffy rules for accountants. Nope, they're the global standard that makes the whole world of finance trustworthy and, actually understandable for the rest of us. So let's dive right in.
So let's start with a really big question. When you look at a company's financial report, any company, how in the world can you trust it? How do you know those numbers are real, that they're reliable, that you can compare them to any other company out there? Honestly, without a shared set of rules, it would just be complete and utter chaos.
Well, the answer is right here. Accounting concepts. Think of them as the official rules of the game. They're the basic assumptions that accountants all over the world have agreed to follow. It creates this common language, this financial Rosetta Stone, that makes global business even possible. Without them, we'd be trying to compare apples and, motorcycles. It just wouldn't work.
So here's how we're going to break it all down today. First, we'll touch on why this is a universal language. Then, we'll get into the big foundational assumptions. After that, we'll look at how transactions actually get recorded, then the rules for fairness and consistency, and finally, we'll tie it all together and see why this is truly the bedrock of business.
Okay, Section 1, Universal Language. Before we jump into the specific rules, let's just quickly understand why this whole framework is so critical for creating order and, most importantly, trust.
Now, for Section 2, the foundational assumptions. These are kind of the big picture rules. They set the stage by defining exactly who and what we're even talking about when we do the books.
Okay, the first one is a biggie, the business entity concept. This is absolutely fundamental. It says that the business is its own legal and financial person, completely separate from its owner. What the business owns, it owns. What the owner owns, they own. You can't mix them up in the books. Period.
And here's what that looks like in the real world. Let's say our friend Rahul has a shop. If he buys supplies for the store, that's a clear business expense. But what if he takes cash out of the register to pay his own personal house rent? Well, that is not a business expense. It gets recorded as drawings, which is just a fancy term for the owner taking money out. Keeping this line clear is so important because blurring it can lead to some massive financial and legal headaches.
Next up, we have the money measurement concept. The rule here is super simple. If you can't put a monetary value on it, rupees, dollars, whatever, you can't record it in the accounting books. This is what keeps accounting objective and focused on things we can actually measure.
In this chart, it lays it out perfectly. Buying 50,000 rupees worth of goods? Yep, that has a clear value, so it gets recorded. But what about the owner's honesty or the team's amazing morale? While those things are incredibly valuable, you can't really put a price tag on them, so they stay out of the official financial statements.
Now, this next one is a huge assumption that underpins everything, the going concern concept. Accounting basically assumes a business is here to stay, that it's not going to shut down tomorrow. It's in it for the long haul. And that's exactly why a company records a brand new machine at the price it paid, not its immediate scrap value. We assume it's going to be used for years and years to make money.
Okay, so we've got the big picture ideas down. Now let's get into the nitty-gritty with Section 3. These are the practical, day-to-day rules that guide how every single financial event gets put into the books.
If you only remember one of these, this might be the one to remember. It's the dual aspect concept. It says that for every single transaction, there are always two effects. This is the foundation of the whole double-entry bookkeeping system, and it's all wrapped up in that famous equation, assets equals liabilities plus capital. The books must always balance, no exceptions.
Let's check back in with Rahul. He invests 1 lakh rupees of his own money to get his shop started. So what happens? Look here. The business's cash, which is an asset, goes up by 1 lakh. And at the exact same time, the owner's investment, his capital, also goes up by 1 lakh. See that? One action, two effects. And the equation stays perfectly balanced.
All right, next we have the cost concept. This rule says that we have to record assets at the price we originally paid for them. So why do we do this? It's simple, really. That original price is objective. It's a fact you can prove with a receipt. So if a company buys a piece of land for 5 lakh rupees, it stays on the books at 5 lakh rupees, even if its market value shoots up to 12 lakh. We stick to the cold, hard facts.
Okay, this next one, the accrual concept, is a real game changer. It's all about timing. It means you record revenue when you earn it and expenses when you incur them, no matter when the cash actually changes hands. Think about it like this. If your employees work all of March but you don't pay them until April, that salary expense still belongs to March's books.
It's about showing what really happened in that period.
And this one, the matching concept, goes hand in hand with what we just talked about. It's pure logic. To get a true sense of how profitable you were in a month, you have to take all the revenues you earned that month and match them up with all the expenses that helped you earn them. That ad you ran in January that brought in customers, that expense belongs in January. Makes sense, right?
So, we've covered the what and the how. Now for Section 4, let's talk about the spirit of the law. These are the principles that make sure financial reports are fair and, just as importantly, can be compared over time.
This one's called the prudence concept, or as it's often known, conservatism. And the motto here is pretty simple: play it safe. Accountants should look ahead and record any potential losses as soon as they seem likely. But on the flip side, you don't get to record profits until you've actually earned them. This is why companies create something called a provision for bad debts. They're basically anticipating that, sadly, some customers just aren't going to pay out.
And last but not least, we've got the consistency concept. This rule is simple. A company has to use the same accounting methods from one year to the next. This is so important because it's what allows investors to compare performance over time. You're always comparing apples to apples. Now, if a company does have to change a method, they have to spell it out very clearly for everyone to see. All right, let's bring it all home in our final section, the bedrock of business. After going through all these rules, what's the point? What's the ultimate payoff? Why should any of this matter to you?
Well, the payoff is huge. When everyone follows these rules, you get accuracy in the company's records. You get financial statements that you can actually rely on. It creates uniformity, so you can compare one business to another. And it creates comparability, so you can see how a single company is doing year after year. It all comes down to one word: trust. It creates trust in the entire system.
So, I'll leave you with this final thought. These concepts are the agreed-upon rules of the game, right? They're the foundation of financial integrity, which really begs the question, what happens when companies decide to, well, bend those rules, or even break them entirely? Now that's a story for another time, but it really shows you just how critical this foundation truly is.